If you're anxious to buy a particular piece of real estate but don't have cash, and for whatever reason know you won't qualify for a mortgage, maybe a problem with your credit score, what can you do? What if it's the chance of a lifetime, the perfect piece of property that you've been looking for years? Do you have to watch your dream walk away? Well, let me tell you about one possible way to make that dream come true. But this method is not without risks and downsides, so pay attention. It's worth considering though if you're savvy. I'm talking about a private money loan, also known as a hard money loan. Rather than borrowing money from a bank, credit union, or mortgage company, you'll be borrowing from an individual or group of individuals who are willing to lend out money quickly as long as a valuable piece of developed property is being purchased and which can be used as collateral. This type of loan is fast, and it depends more on the value of the property to be purchased than it does on the buyer's credit rating. Now, don't expect to get a hard money loan for a completely undeveloped piece of raw land with no utilities and no easement. I'm not saying it's impossible, but hard money lenders usually only hand over their money to buy developed properties that the lender can resell quickly if the borrower can't pay back the debt. Hard money loans have emerged as an interesting alternative to traditional bank loans for real estate investors, developers, flippers, and private individuals, but they're not for everyone. Probably one of the most important advantages of hard money lending is the speed with which borrowers can access funds. Unlike traditional bank loans, where the approval process usually takes about a month here in Idaho, where I'm a realtor, and may take longer in other parts of the country, hard money lenders often approve their loans quickly, allowing investors to capitalize on time-sensitive opportunities such as buying undervalued properties or participating in auctions. Private money lenders are also known for their flexibility when structuring loan terms. They can change the financing to meet the needs of the borrower and the specific product, so they're more personalized than a traditional lender. As an example, take a real estate investor who spots a terrific distressed property that's about to go on the auction block. She recognizes the property's potential once it's been renovated, but needs to be able to move quickly to participate in the auction. A hard money loan can be really beneficial for a situation like this one, allowing the investor to snap it up, renovate it, sell it quickly. A buyer who had to wait for a traditional loan to be approved might still be waiting on the day of the auction and thus find himself locked out of a possible money-making opportunity. And in traditional lending, the borrower's creditworthiness is crucial to getting loan acceptance. Everything from credit scores to tax returns and documents from the borrower's employer will be scrutinized before the loan can be approved. The property itself will need to be appraised, and if the appraiser feels it's not worth the purchase price, the entire transaction may very well fall through. Hard money lenders, on the other hand, focus on the value of the collateral, which is typically the property being purchased. This means that borrowers with less than perfect credit scores, or who already have another mortgage or two or three, can still obtain funding based on the value of the property itself. As another example, how about a real estate developer who has several projects in the pipeline with traditional mortgages on all of them? Now a wonderful opportunity comes along, but the bank says, no, you have too much debt already. But with a valuable piece of property to be purchased and to be used as the collateral, a hard money lender may be happy to lend the money needed to make the purchase and to do it quickly too. Private money is also helpful for higher risk or unconventional real estate projects, the kind of projects that conventional lenders usually are not willing to touch. An example might be a downtown historic building that needs a lot of work, but which has so much potential for conversion into luxury apartments or a commercial complex. A conventional lender might be concerned that the borrower would have trouble finishing such a project. But a hard money lender simply sees the potential and is willing to lend money based on just that, the potential. Hard money lenders are more willing to take on higher risk ventures or to finance unconventional real estate projects that conventional banks might shy away from. Now, while all of this sounds great, and it is great for certain people in certain circumstances, keep in mind that a hard money loan has some serious downsides. The first is high interest rates, like really, really high interest rates, maybe 8 to 15% more than the rates offered by a bank. Private lenders are taking on a lot more risk. More risk means the lender is going to charge proportionally more for the loan. Also, and this always surprises people, these loans are typically for a much shorter term than a conventional loan, like 1 to 3 years, maybe as long as 5 years, but that's about the limit nowadays. This short time frame for paying back the loan puts pressure on borrowers to complete their projects quickly. That's not always a good thing. Overall, your monthly payments for a private money loan are going to be huge compared to the monthly payments for a 30-year conventional loan. But you will be paying off the loan much quicker. You'll actually spend less money overall for the hard money loan because of the relatively short time frame for paying back the loan. And if you want to do a fun exercise, pull up an online mortgage calculator, calculate the monthly payments for, say, a $400,000 loan at 7% interest for 30 years. That's your conventional loan. Now calculate the payments for the same loan at 15% for 3 years. This would be your hard money loan. The monthly payments for the hard money loan are terrifyingly large compared to the conventional loan. But if you look at the overall amount of money paid to the lender over the 3-year period versus the 30-year period, it is going to be significantly lower. But affording those gigantic monthly payments would be very challenging for most people. And I have to mention the potential for scams with private money loans. The private lending industry is generally reputable, but there is a risk of encountering unscrupulous lenders and predatory practices. So remember, private money lenders aren't required to follow the rules and regulations that conventional lenders are tied to. So borrowers must be vigilant and conduct thorough due diligence before committing to a hard money loan to avoid falling victim to hidden fees, exorbitant penalties, or unfair loan terms. There's no government oversight for private loans, so tread carefully. You're in this on your own. I hope this has given you some food for thought if you're considering a hard money loan. If this video was helpful, please give it a like or leave a comment, and be sure to check out this next video on buying raw land. Thanks.